The Bank of Mom and Dad has become one of the largest financial entities in the world. According to a 2019 study, American parents collectively ranked as the seventh largest mortgage lender in the United States, having financed over $47.3 billion in the previous year. What makes this figure even more impressive is that most parents are not financing full property purchases. Instead, they are contributing to down payments, enabling their children to secure larger loans from traditional banks. This trend reflects a broader societal shift in the normalization of debt. However, the Bank of Mom and Dad is not limited to real estate. A survey conducted by Savings.com found that parents were providing an average of $1,474 per month to their adult children to cover basic living expenses such as groceries, medicine, and fuel. Additional funds were also used to pay for phone bills and even vacations. Despite being over the age of 30, millennials remain regular beneficiaries, receiving an average of nearly $900 per month from their parents. This average is likely influenced by families who offer substantial financial support from the outset of their children's lives. At the same time, there is growing concern that parents are allocating more money towards supporting their adult children than toward their own retirement. The financial arrangements between parents and children have become increasingly sophisticated, involving equity releases, financial guarantees, complex benefit structures, and formal terms and conditions. If there is ever a widespread demand on this system, it may result in a crisis where parents cannot retire and children cannot become independent. More than 50% of individuals aged 18 to 29 continue to live with their parents. Without parental support, many young adults would be unable to afford housing, transportation, or basic necessities. There are three distinct groups negatively affected by this financial dynamic: parents who continue supporting their children well into adulthood, children whose families cannot afford to assist them, and the financially supported children themselves, who may be subject to restrictive conditions on how they use the funds. Around half of young adults receive no financial support from their parents at all, often due to financial limitations, estranged relationships, or the death of a parent. The absence of this support network leads to significant financial disadvantages. For many, the challenge of balancing jobs, education, ambitions, and basic living expenses becomes overwhelming. In much of the U.S., obtaining employment often requires a vehicle, which in turn requires money or loans. Pursuing higher education involves more loans, and securing housing demands deposits and furnishings. Even before the first paycheck arrives, basic needs must be met. Without initial support, many are forced to rely on high-interest debt. Even modest forms of assistance, like a place to sleep or access to a car, provide a critical head start. These small safety nets can empower young adults to take calculated risks early in their careers. For instance, accepting an unpaid internship in an expensive city may only be possible with the reassurance of a parental safety net. This type of support can mean the difference between a high-paying future and settling for safer, less lucrative options. It is for this reason that many successful professionals come from stable financial backgrounds, because the ability to take risks is itself a privilege. According to MIT economist Peter Timman, it now takes at least 20 years to escape poverty, assuming no setbacks. Much of today's wealth inequality can be traced back to the 1970s, when productivity continued to grow, but wages stagnated. During this period, people with professional incomes were able to accumulate real estate and financial assets, while those without assets increasingly turned to debt. For the wealthy, debt became a tool for building equity. For everyone else, it became a burden. The reason homes are so expensive today is that people can borrow to buy them, whether from banks or from their parents. This dynamic can be compared to starting a fire. Building one from scratch is difficult, and even small challenges can extinguish it. However, borrowing a flame from an existing fire that has been burning since the 1970s makes the task much easier. Once a fire is burning, it is harder to put out. This analogy highlights how entrenched and powerful nepotism has become. The real issue is how much these financial advantages obscure deeper structural problems. The methods parents use to support their children have become increasingly complex, often borrowing tools from the formal financial sector. Reverse mortgages, also known as home equity conversion mortgages, have become a popular way for parents to raise capital. These products allow older homeowners with paid-off properties to borrow against the value of their homes. A homeowner with a $450,000 house can typically receive a loan of about $150,000. These loans do not require repayment until the homeowner sells the house or passes away, at which point the lender collects the loan plus interest. These reverse mortgages were especially popular in the early 2000s, helping families fund lifestyle expenses or invest in additional properties. Although tighter regulations have since limited their use, the rising value of homes has made these loans more financially significant. The financial industry favors these products due to their higher interest rates and fees. Two main reasons are driving their resurgence. First, families need money. Even after decades of working, most people still hold the majority of their net worth in their homes. Unlike stocks, homes cannot be sold in pieces, and retirement costs are rising. Second, more parents are choosing to refinance their homes to provide an early inheritance to their children. Financial institutions such as Merrill Lynch have entire planning departments dedicated to this trend. This approach offers several benefits. Parents can witness their children using the money, provide support when it is most impactful, and potentially reduce the tax burden on their estates. Research shows that most people would prefer to receive $250,000 at age 30 rather than $1 million at age 50. Early financial support can be life-changing, helping with homeownership, education, or raising a family. However, these early inheritances often come with strings attached. Parents frequently impose conditions, which may include financial advice or more personal directives regarding career choices, relationships, and lifestyle decisions. According to the same Savings.com survey, 77% of parents who gave money to their children did so with conditions. While some may offer practical guidance, many use the opportunity to exert control, extending dependency longer than necessary. This kind of assistance, while seemingly generous, can also be burdensome. It is difficult for young adults to reject financial help when the advantages are so significant, yet accepting it often means sacrificing personal independence. Meanwhile, many young people without such support find themselves falling behind, regardless of how hard they work or how much they earn. Even high salaries often cannot compete with a modest income supplemented by parental assistance. This financial imbalance has also contributed to the rising costs of major life milestones. College tuition has soared due to the widespread availability of student loans. Similarly, the housing market has inflated as low deposit mortgages and tax incentives have made borrowing easier. The growing normalization of early parental assistance has made these milestones even more expensive, particularly for those who lack access to family wealth. As a result, many parents feel compelled to help their children financially, even when doing so puts their own futures at risk. Nearly half of surveyed parents admitted to making personal financial sacrifices to support their adult children, most commonly by withdrawing from retirement savings. This situation is unsustainable. The bank of mom and dad is not only failing to benefit parents, it is also harming children by delaying their independence and creating a playing field where only those with wealthy families can compete. Ultimately, this system disadvantages everyone. Parents struggle to retire, children face conditions on their freedom, families without resources fall further behind, and future generations may never exist because the financial burden of raising children has become too great. According to Pew Research, many adults, especially high earners, are postponing or foregoing having children because they cannot meet both their own financial goals and the expected support their children may require. If providing long-term financial aid becomes a standard part of parenthood, fewer people will feel financially secure enough to start families at all. The only solution is to make it easier for young people to become self-sufficient. But before that can happen, society must first understand why achieving independence has become so difficult. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.